question mark really is whether the Fed does the Fed risk doing too much, too soon or too late. Let's discuss that and the impact of the rising interest rates globally with two eminent experts, Zhou, he's senior market economist at Commerzbank, and Geoff Lewis. He is senior Asia strategist at Capital Markets and Strategy Group at Manulife Asset Management. One guest from Singapore, one guest from Hong Kong. Gentlemen, both of you, good morning to you as well, and thank you so much for joining in. Geoff, let me start off with you. To my mind, this was par for the course, except for the fact that the statement was peppered with the word strong, almost making it a given that we'll see some action in September. What did you make of it?
Yes, I think the change in the language was the most interesting thing. I think it's a given that the Fed funds rate will go up in September. The market's less sure about December, but I think the Fed is pretty much on track to keep raising rates on the path it said it has. So I think the real problem is going to come next year when the markets and the Fed are much further apart, and the Fed is telling us that by the end of the year it's going to be raising rates above the neutral level for a while, and I think that's when you have this worry that the Fed will make the traditional mistake of over-tightening and bringing on a recession.
Zhou, good morning to you as well, and do you concur with that? Because there is a counter-narrative out to this belief that what the Fed is doing by consistent statements after every policy and taking a pause in between is preparing the markets enough for what is, in their minds, a gradual rate tightening cycle.
Well, I think it's very justified to see that the U.S. actually on a gradual rate hike process, given that I think the U.S. economy is in a sweet spot. The labor market performed quite well, and the corporate earnings are relatively strong, and the inflation on the rise. So there's definitely, I think, another 3 to 4 hikes in the next couple of quarters is definitely justified. December hike, I think, is on the table. And for next year, we do see another at least 2 rate hikes. So the problem right now is that whether the Fed will hike too much, I don't know, but I don't think at this moment, given that the economic fundamentals still relatively strong, and Fed is just on the kind of hike on according to its own schedule and its own projection. So I think right now I couldn't see too much risk of the rate hike process from the U.S.
How you believe 2 more hikes this calendar itself?
Yes, I believe there will be 2 in September and in December respectively.
Now, Geoff, you used the word over-tightening, but I think you used it with reference to 2019. Would 2 more hikes, to your mind, be a given, and would that be over-tightening? Part 2 of my question, Geoff, would be that even though the Fed may intend to do that and the economy may remain strong, would the markets allow the Fed to do that?
I think most of us expect that growth will be decelerated next year. 4% for the second quarter is way above productive potential. And as long as we don't see inflation really beginning to take off, and there's no sign of that so far, then I think the Fed and the markets could come to a compromise. Perhaps the Fed's stopping a little before the dot plots signal, and the markets being content with that. That would be the best possible outcome, I think.
And you don't think, I mean, this was one instance wherein Jerome Powell almost did not bend down to pressure, because Donald Trump has made it amply clear that he would want this pace or the rises to stop as well. You don't think that will be a factor at play either, Geoff?
Well, I think what Donald Trump said was that he's not in favor of higher rates, but he also said he's content to leave it to the Fed. So that was just him expressing an opinion. I don't think we should say that the White House is trying to undermine the Fed's independence or to put heavy pressure on them at this stage. I think that's putting too much weight on one particular sentence from Donald Trump.
Okay. What does all of this do to financial markets? We haven't had a major reaction, in part, I believe, because the Fed all through the last 4 or 5 or 6 odd months or to the calendar has prepared the markets amply about what the rate hike trajectory would be like. What do you think the near term has in store? Because it's not just the Fed. Central bankers world over. I mean, India is a smaller part of the world puzzle, but India has seen a small hike too. BOE comes out with the decision too. What do you expect this general rate tightening across the world to do to financial markets?
Well, I think, in general, we do see that in the DM market, the problem is that, there will be a kind of further tightening, especially from the Fed. And we do see that quite interesting comments from Bank of Japan yesterday. And, looks like the rates in Japan will also rise. So Bank of England, definitely the rate hike is very likely. But for the DM, for the EM markets, for emerging markets, the problem is that they have to hike interest rate to prevent capital outflows, especially like India, Indonesia, Philippines, Turkey, especially. So basically, I think there's a different themes in DM and EM at this moment. So the market impact onto different financial markets would be different also. For U.S. and for the developed market, I believe that financial market will perform still relatively solidly, especially the U.S. stocks. But in the emerging markets, I do see that there could be further pressure, especially because that the economic growth could be dampened if there's a continued tightening process. But in the meantime, the pressure on the currency are still there. So I'm relatively cautious in emerging markets as a whole, but relatively bullish on the advanced economies at this moment.
Geoff, is that your view too? EMs have seen some reversal of flows as well, in the sense that there are some inflows coming into EMs. India has seen that too. China has seen that in the last 1 month. Flows notwithstanding, are you bearish EMs by and large and bullish on DMs, or is it the other way around?
I think there's been consistent selling from EMs, but it does signal, I think, that we're reaching the end of that at the moment. So unless there are further adverse developments, say, on the trade friction front, I think we've probably seen the worst. China, through its changes in policies on both fiscal, monetary and exchange rates, is signaling that it's going to protect its growth rate. I think it's done enough for that, and that could offer support to emerging markets going forwards.
Okay, gentlemen, both of you, thank you so much for taking the time out and joining us this morning on Bloomberg Quint India. Much appreciate your time.